Today we will review the economic trends of the 20th century. The rapid industrialization of the late 1800s radically transformed America. While business boomed and monopolies flourished under the pro-business policies of the federal government, the lives of ordinary people were transformed too, but not always for the better. The workers at the factories who made the new mass-produced goods had none of the protections and rights that we expect today. But slowly, a movement of people grew who began to put pressure on their local and state governments to make laws to change the status quo. These reformers were mainly from the middle class. They were educated, but not members of the elite. They were journalists, intellectuals, and local politicians. Together, they are now considered the foot soldiers of the progressive movement. One of the main goals of these progressives was to correct the economic injustices of industrialized life. Some of their first victories dealt with this exact problem. Child labor was finally banned at the state level. Laws limited the workday to 8 hours and 40 hours a week. Workers' compensation finally became an accepted industry practice. At the same time, journalists, known as muckrakers, did more to expose the inequalities of American society. By 1900, trusts controlled 4/5 of American industries. Ida Tarbell wrote about the corrupt business practices of the Standard Oil Company and other trusts. This helped contribute to a growing sentiment that monopolies needed to be regulated for the public good. When Teddy Roosevelt became president, he used the 20-year-old Sherman Antitrust Act to bust famous trusts like U.S. Steel. Roosevelt didn't use his trust-busting powers aggressively. He only filed suit against 44 trusts, and of those, won only a few cases. But still, his actions were unprecedented. Roosevelt also signed the Elkins and Hepburn Acts, which regulated the railroads and prevented unfair rate setting and corrupt rebates. These laws finally gave power to the federal government to regulate the railroads, an endeavor that had begun with the Interstate Commerce Act in the 1880s. Another progressive president, Woodrow Wilson, signed into law a more powerful law, the Clayton Antitrust Act, which is still used today to prevent monopolistic business practices. He also created the Federal Trade Commission in 1914, which was given the power to stop unfair or illegal business practices. By 1920, the power of business regulation was in the hands of the government. Another muckraker, Upton Sinclair, wrote an expose of the meatpacking industry called The Jungle. The book revealed not only the horrible working conditions, but the unsanitary disregard for consumer health. The Jungle sparked more reforms at the federal level. Teddy Roosevelt passed the Meat Inspection Act and the Pure Food and Drug Act of 1906, both of which required companies to guarantee the safety of their products. This was unprecedented. But what was even more unusual was when Roosevelt used his power as president to fairly negotiate a coal strike. Previously, presidents had always stepped in on the side of business owners, but this time Roosevelt took a neutral position and negotiated a settlement that was more balanced. More radical changes came with the progressive era in terms of finance. In 1914, Woodrow Wilson created the Federal Reserve, the first national banking system since Andrew Jackson destroyed the Bank of the United States in the 1830s. The Federal Reserve created 12 regional banks which could issue paper currency and set monetary policy. The Federal Reserve System brought order to the American economy after decades of financial instability. But more importantly, the Federal Reserve banks served as bankers' banks. They could loan money to banks in case of a need for more reserves, just like they did in the banking crisis of 2008. The 16th Amendment also brought order to government budgets. The 16th Amendment legalized the graduated income tax. This brought in a whole new stream of revenue, reducing the demand for such high tariffs, as you can see in the chart. Woodrow Wilson passed the Underwood Tariff, which cut tariff rates dramatically. This period of time represents a dramatic reversal from the previous century of economic policies. The laissez-faire pro-business policies of the 1800s were finally giving in to a bit of government regulation. A new idea was beginning to emerge, that the government has a duty to provide for the welfare of the people. And then World War I arrived. During times of crisis, people are willing to submit to a bit more government control than they would normally. Just as in wars past, the role of the government in the economy increased. The federal government created many new agencies to direct the war effort. The main regulatory body was the War Industries Board, which encouraged businesses to use mass production techniques to increase efficiency and standardize products, set production quotas, and allocate raw materials. The Railroad Administration controlled the railroads. The Fuel Administration monitored coal supplies and rationed gasoline and heating oil, and instituted daylight savings time. Americans also voluntarily changed their ways to conserve for the war effort. Many people adopted gasless Sundays and lightless nights. They planted victory gardens and conserved food at the bequest of the Food Administration. The National War Labor Board was established to deal with disputes between management and labor, sternly but fairly. While American soldiers were in the trenches in France dying, American business was making a killing in profits, and their stockholders too. Individual household income also increased due to wage increases in the booming war economy. However, ordinary Americans didn't really get to enjoy the benefits of higher incomes because of soaring retail prices, as you can see in this chart, due to increased government spending and ration supplies. One group, however, did particularly well: farmers. Since most of Europe was consumed in war, there was a global demand for American agricultural goods. The skyrocketing profits encouraged American farmers to take out loans and expand their production. When World War I was over, America was one of the financial powerhouses of the world. American banks set up the Dawes Plan to maintain financial stability in Europe. The American stock markets were endlessly climbing. Business profits just kept on growing, especially in companies like Radio Corporation of America and Ford. Pro-business policies pursued by the Republican presidents Harding, Coolidge, and Hoover spurred the boom times. Tariff rates were raised once again under the Forney-McCumber Tariff Act to the highest rates yet. In the pro-business spirit of the 1920s, income taxes were lowered. In addition, credit was made more easily available to companies, and government intervention was minimalized. Many of the advances of the progressive era were reversed during the 1920s. For example, the federal government stopped busting trusts and didn't pursue regulatory action through the new agencies of the 19s. As Coolidge said, "The chief business of the American people is business." And oh, did Americans enjoy the boom times. Advertising convinced Americans to buy more and more, encouraging them to use the installment plan to buy what they couldn't afford now and pay it back later. In the 1920s, most homes and automobiles were purchased with this method. The installment plan came to symbolize the superficial prosperity of the 1920s. While all appeared to be jolly and glamorous in the 1920s, the truth was that the foundation of the whole period was debt. Consumers were in debt from their purchases on the installment plan. With so much debt, pretty soon spending decreased, hurting business. Farmers were in debt. Overexpansion during World War I had led to overproduction, lowering prices for agricultural goods. Farmers who had taken out loans to expand their production during the fruitful war years were foreclosed upon and had to revert to tenant farming. Other industries were also hurting, such as mining, lumber, and construction. Investors were in debt. Stock prices were soaring, but that was mostly due to the practice of buying on margin. Most of the money that was being invested in the stocks wasn't real, but borrowed, sometimes upwards of 80% of the stock value. So, the whole house came crumbling down on October 29th, 1929, when the stock market crashed. Thousands of people who had bought stocks on credit were stuck with huge debts as the prices plummeted, while others lost most of their savings. After the crash, many people panicked and withdrew their money from banks, but some couldn't get their money because the banks had invested it in the stock market. By 1930, 11,000 of the nation's 25,000 banks had failed. Because the government did not protect or insure bank accounts, millions of people lost their savings. These beginning stages of the Great Depression hit businesses too. Between 1929 and 1932, approximately 90,000 businesses went bankrupt. Therefore, millions of workers lost their jobs. Unemployment leapt from 3 to 25%. That's 1 out of every 4 people who lost their job. And then, in 1930, Congress passed the Hawley-Smoot Tariff, which established the highest protective tariff in U.S. history. It was designed to protect American farmers and manufacturers from foreign competition, but actually made the situation worse by decreasing trade and causing European countries to raise their own tariffs. In a few years, world trade had fallen more than 40%. As the economy tanked, President Hoover tried to reassure Americans that the nation's economy was sound. In his view, the best course was to do nothing and let the economy fix itself. But as it became apparent that something needed to be done, Hoover took a laissez-faire approach, based on his deeply held convictions in small government. Hoover firmly believed that it wasn't the place for the government to give any direct relief to the needy because it would weaken people's self-respect. Instead, his answer to the needy was that individuals, charities, and local organizations should pitch in to help care for the less fortunate. But as time went on and the Depression deepened, Hoover gradually softened his position on government intervention in the economy and took a more activist approach to the nation's economic troubles. Hoover signed into law the Federal Home Loan Bank Act, which lowered mortgage rates for homeowners and allowed farmers to refinance their farms and avoid foreclosures. He also signed the Reconstruction Finance Corporation Act, which authorized up to $2 billion for emergency financing for banks and other large businesses. The RFC was an unprecedented example of federal involvement in a peacetime economy, but in the end, it was too little, too late. The 1932 election showed that Americans were clearly ready for a change. Unlike Hoover, the Democratic candidate, Franklin Delano Roosevelt, projected an air of confidence that attracted voters. Americans loved him, as well as the New Deal he proposed for relief for the needy, economic recovery, and financial reform. The New Deal laws passed during the first 100 days of Roosevelt's term were a dramatic change in approach from any other president in U.S. history. This period marks a radical departure in the philosophy of politicians, both Republicans and Democrats, about the role of the government in regulating the economy. The New Deal included financial reform laws like the Federal Deposit Insurance Corporation, which provided federal insurance for individual bank accounts. Also, the Securities and Exchange Commission, which was given the power to regulate the stock market and prevent insider trading. The New Deal gave subsidies, such as in the Agricultural Adjustment Act, which paid farmers to leave a certain amount of every acre of land unseeded to boost prices. Other New Deal programs focused on providing work, such as the Civilian Conservation Corps, which employed young men in civil works projects. The New Deal did much to improve labor conditions. The Wagner Act guaranteed the right for unions to collectively bargain and prohibited unfair labor practices. The Fair Labor Standards Act set maximum hours at 40 hours a week and also established a minimum wage. But the most enduring legacy of the New Deal was the Social Security Act, which created pensions for those 65 and older, unemployment compensation, and aid to families with dependent children. The Roosevelt administration greatly expanded the power of the federal government, giving it a more active role in shaping the economy. But to do so, the federal government had to go deeply into debt. The federal deficit increased dramatically, but what really ended the Depression was the massive amount of spending by the federal government for the guns, tanks, ships, airplanes, and all the other equipment and supplies the country needed for the World War II effort, as you can see in this chart. During the war, the deficit reached a high of about $54.5 billion in 1944. Like during World War I, the nation's economy completely retooled itself during World War II. Almost overnight, factories of all types shut down commercial production and converted to defense production: tanks, planes, boats, command cars. Nearly 18 million workers were laboring in war industries. More than 6 million were women. As war production increased, there were fewer consumer products available for purchase. With demand increasing and supplies dropping, prices seemed likely to shoot upwards, just like during World War I. However, Roosevelt responded to the threat of inflation by creating the Office of Price Administration, the OPA. The OPA fought inflation by freezing prices on most goods and rationing goods. Congress also raised taxes to fund the war and decrease consumer demand. Besides controlling inflation, the federal government needed to ensure that the armed forces and war industries received the resources they needed. So, the War Production Board was created. The War Production Board decided which companies would convert from peacetime to wartime production, allocated raw materials to key industries, and organized nationwide drives to collect scrap materials. In contrast to the Great Depression, World War II was a time of opportunity for millions of Americans. Jobs abounded, and despite rationing and shortages, people had money to spend. Farming also prospered during World War II. By the end of the war, the nation emerged as the world's dominant economic power. But that doesn't mean that the economic readjustment from wartime to peacetime wasn't difficult. When the war ended, thousands of defense workers were laid off and unemployment increased. Many industries suffered from strikes due to lower wages and less work. Rationing and other inflation-fighting measures ended, so prices skyrocketed by almost 25%. But the economy didn't go into recession because so many Americans had saved up money during the war and started to spend. The 1950s were boom times in America, as you can see in these charts. Businesses expanded rapidly. People had more money to spend. People were encouraged to spend even more by the advertisements on television and the invention of the credit card. More and more families moved to the suburbs and spent their money on leisure activities. The American economy was also stimulated by Cold War defense spending, as well as foreign aid programs like the Marshall Plan, which helped create an international market for American exports. Defense spending escalated throughout the 50s, 60s, and 70s, especially due to the war in Vietnam. Eisenhower, in his last speech as president, warned America of the dangers of the military-industrial complex, the dangerous economic addiction to defense spending as a way to feed the economy. His warning proved to be insightful, as even today we are addicted to defense spending and deficit spending as ways to boost the economy. Government fiscal policy also continued to deficit spend on welfare programs. Presidents Truman, Eisenhower, and Kennedy all passed laws that raised the minimum wage. They also extended Social Security to more people, as you can see on this timeline. But the most dramatic expansion of welfare, other than the New Deal, was Lyndon B. Johnson's Great Society. The Great Society's war on poverty created youth programs, education funding, low-income housing, government health insurance, all that are still used today, especially Medicare and Medicaid. Even though congressional funding for the Great Society programs were cut due to the Vietnam War, many of the Great Society programs still exist today. However, after 2 decades of increased spending on both welfare and war, tough economic times were in store for the 1970s. Government spending and increased oil prices created high inflation, while at the same time, unemployment increased due to a larger workforce and increased global competition. The simultaneous problems of high unemployment and high inflation, as you can see on the graph, is called stagflation, and first emerged while President Nixon was in the White House. Nixon, Ford, and Carter all tried to remedy the problems of stagflation, but were not successful. Because people were anxious about the economy, in 1980, their concern opened the door for new approaches to taxes in the federal government, a new tide of conservatism. Conservative trends in government economic policy started with Nixon in 1968. Nixon believed that the role of the federal government in the economy had grown too large with the Great Society. He decentralized power through revenue sharing with the states and dismantled many of the Great Society programs. When Reagan was elected in 1980, he continued the downsizing. Reagan pursued deregulation of the airline and banking industries and defunded the federal environmental agencies. At the heart of Reagan and many conservatives' approach to the economy was the belief that reducing the size and influence of the federal government would encourage private investment. This theory is called Reaganomics, or supply-side economics. This theory held that if people paid fewer taxes, they would save more money. Banks could then loan that money to businesses, which could invest the money in making new jobs, increasing productivity and driving down prices. Based on this theory, Reagan lowered taxes by almost 25% and cut government spending on programs for the poor. The economy did recover from stagflation, but the economy had some underlying weaknesses during this era. The gap between the rich and the poor increased in the 1980s because the rich paid far less in taxes, while the poor had to pay more because of the welfare programs that were being defunded. Another trouble with the economy under Reagan is that the federal deficit more than doubled because of defense spending on Cold War programs that dramatically increased, such as the funding for the Star Wars initiative. Today, our government is still in massive debt. We will have to, as a nation, face the fact that we cannot continue to cut taxes and increase spending without any consequences. We must demand that our government not pass their debts onto us and our children.